Picture this. You've done everything right. You played by the rules for 40 years. You woke up at 6 a.m., fought through traffic, dealt with the bosses, the deadlines, the stress. You skipped the fancy cars. You cooked at home. You diligently shoved money into your 401k and your IRA because everyone, your HR rep, your parents, the finance gurus on TV, told you to. Defer taxes now, they said. You'll be in a lower bracket when you retire. So you retire. You're 65. You and your spouse have a nice nest egg, let's say $1 million, and decent Social Security checks coming in. You sit down at your kitchen table to do your budget. You do the back of the napkin math and figure, okay, based on our income, we're firmly in the 12% tax bracket, maybe 22% if we splurge. So you decide to take out an extra $10,000 from your IRA. Maybe the roof needs fixing. Maybe you want to take the grandkids to Disney World. You think, worst case scenario, I owe the IRS $1,200. But then April rolls around. You file your return, and suddenly you realize that extra $10,000 didn't cost you $1,200 in taxes. It cost you nearly $4,000. You stare at the paper. You check the math. You check it again. You call your accountant, thinking there's a mistake. And they tell you, no, that's correct. You realize you just paid a marginal tax rate of nearly 50%. You're not a billionaire. You're not a hedge fund manager. You're a middle-class retiree living in the suburbs, and you just got hit by the tax torpedo. That feeling in your stomach, that isn't just confusion. It's the realization that the U.S. tax code has a trap door, and you just fell through it. My name is Bond, and I spend way too much time thinking about tax efficiency, provisional income formulas, and exactly how the government plans to extract wealth from your retirement accounts. If you're someone who has spent a lifetime saving in tax-deferred accounts, and you are terrified of giving half of it back to the IRS because of a math error, make sure to hit the subscribe button and give this video a thumbs up. Because today, we aren't just doing a surface-level overview, we are doing a deep dive. I am going to show you the exact math using the new 2025 tax numbers behind why this happens, and more importantly, exactly how to disarm the torpedo before it sinks your retirement. Buckle up, we have a lot of math to do. The Great Deferral Myth. Here's the thing. Most of us are operating on a financial belief that feels intuitively true, but is mathematically dangerous. The belief is this: I will be in a lower tax bracket when I retire. It makes sense on paper, right? When you're working, you are in your peak earning years. Maybe you're making $150,000 combined. When you retire, you don't need to save anymore. The mortgage is paid off. The kids are gone. You're living on less. Therefore, taxes go down. That is the entire sales pitch of the traditional 401k. Defer taxes at 24% today, pay them at 12% tomorrow. But here's what most people don't realize. The U.S. tax code isn't a linear staircase. It's not a straight line where you make less and pay less. It's a minefield. And specifically for retirees, there is a weird, glitchy interaction between your Social Security benefits and your other income that creates a phantom tax bracket. We call it the tax torpedo. Now, you might be thinking, Bond, come on, taxes are simple. If I make $50,000, I pay the rate for $50,000. I wish it were that simple. If it were that simple, I wouldn't need to make this video. To understand why it's not, we have to talk about the standard deduction and the provisional income formula. These two things interact in a way that essentially punishes you for having saved too much in tax-deferred accounts. See, when you were working, the tax code was straightforward. You earned wages, you pay tax. Simple. When you retire, you have 3 distinct buckets of money, and the IRS treats them all differently. Social Security, sometimes tax-free, sometimes taxable. Capital gains, taxed at preferred rates, 0, 15, 20%. Ordinary income, this is your IRA, 401k withdrawals, taxed at full rates. The tax torpedo happens when bucket number 3 spills over and contaminates bucket number 1. The mechanics of the torpedo, the math deep dive. Okay, let's get into the weeds. I'm going to put a spreadsheet up on the screen. Don't click away. This specific math is worth tens of thousands of dollars to your future self. The tax torpedo exists because of how the IRS determines how much of your Social Security is taxable. Social Security is unique. It's tax-free until you cross a line. The IRS uses a formula called Provisional Income, or sometimes combined income, to make this decision. The formula is provisional income equals MAGI plus tax-exempt interest plus 50% of your Social Security benefit. Let's break that down. MAGI is your modified adjusted gross income. This includes your IRA withdrawals, your interest from the bank, your dividends. Tax-exempt interest is municipal bond interest. Yes, the IRS counts that here even if it's tax-free. And then they add half of your Social Security check. Here are the thresholds for a married couple filing jointly. Below $32,000, zero of your Social Security is taxed. Between $32,000 and $44,000, up to 50% of your benefits are taxable. Above $44,000, up to 85% of your benefits are taxable. Now, look at those numbers, $32,000 and $44,000. These numbers were set decades ago. They were never indexed for inflation. Let me repeat that. In 1984, when they created this tax, these thresholds affected only the ultra-wealthy. Today, because of inflation, these thresholds hit middle-class retirees. The rich person tax became the every person tax. Here is where the math gets crazy. This is the double taxation effect. Imagine you are a married couple. You receive $60,000 in Social Security. You take $40,000 from your IRA. You need $1 extra for a cup of coffee. You pull $1 from your IRA. That $1 is taxable income. Obviously, you owe, say, 12 cents on it. But because you increase your MAGI by $1, your provisional income also goes up. And because you're in the 85% zone, above $44,000, that $1 of withdrawal forces $0.85 of your Social Security to suddenly become taxable. So look at the chain reaction. You withdraw $1. The IRS taxes that $1. The IRS also adds $0.85 of Social Security to your taxable income. Your taxable income didn't go up by $1. It went up by $1.85. If you're in the 22% tax bracket, which is most middle-class retirees, you're paying 22% on $1.85. Let's do the math. $1.85 times 0.22 equals $0.407. Did you catch that? You withdrew $1. You paid 41 cents in tax. That is a 40.7% marginal tax rate. That is higher than the tax bracket for a single person making $500,000, and you're paying it on a retirement income of $80,000 or $90,000. This is the tax torpedo. It's a surcharge on your savings that acts like an invisible fence. You step over it and you get shocked. A real-world scenario. Bob and Linda, 2025. Okay, Bond, that's theory. Show me the real numbers. Let's look at a case study for the 2025 tax year. Meet Bob and Linda. They are 66 years old. They live in Ohio. Social Security, $60,000 combined, a solid upper-middle-class benefit. IRA balance, $1 million. Required income, they need about $80,000 to cover their lifestyle. So they take their $60,000 from Social Security. They need another $20,000. They withdraw $20,000 from the IRA. Let's run the tax return. Gross income, $20,000 IRA plus Social Security. Provisional income calculation, $20,000 IRA plus $30,000, half of Social Security, equals $50,000. Since their provisional income, $50,000, is slightly over the $44,000 threshold, some of their Social Security becomes taxable. Using the IRS worksheet, about $10,100 of their Social Security becomes taxable. Total taxable income, $20,000 IRA plus $10,100 SS equals $30,100. Standard deduction, 2025, the standard deduction for a married couple over 65 is roughly $34,700, base $31,500, plus additional for age. Look at that. Taxable income, $30,100, minus standard deduction, $34,700, equals less than zero. Bob and Linda pay $0 in federal income tax. They are ecstatic. They feel like financial geniuses. They have $80,000 in spendable cash and paid zero to Uncle Sam. This is the tax valley. It's a beautiful place to be. But here comes the problem. Bob wants to buy a boat, or maybe Linda needs a new hip and wants the best surgeon out of network, or maybe the roof leaks. They decide to withdraw an additional $40,000 from the IRA. They think, we paid zero tax on the first chunk, we're in the 12% bracket. this $40,000 will cost us maybe $4,800. Let's rerun the numbers with that extra $40,000 withdrawal. New IRA withdrawal, $60,000 total. New provisional income, $60,000 IRA plus $30,000 half of SSS equals $90,000. Now they are way above the $44,000 threshold. The formula pushes the taxable amount of their Social Security from $10,100 all the way up to $44,100. New total taxable income, $60,000 IRA plus $44,100 SSS equals $104,100. Minus standard deduction, $104,100 minus $34,700 equals $69,400. They now have $69,400 of taxable income. This puts them partially in the 10% bracket and partially in the 12% bracket. Their total tax bill comes out to roughly $7,900. Wait a minute. When they took $20,000, the tax was zero. When they took $60,000, an extra $40,000 withdrawal, the tax was $7,900. $7,900 divided by the extra $40,000 withdrawal equals 19.75%. Okay, 19.75% isn't 50%, but we aren't done yet. Let's look at the specific dollars. What if they pull just one more $10,000 chunk? If they go from $60,000 withdrawal to $70,000 withdrawal, the tax bill jumps from $7,900 to roughly $11,500. That's a $3,600 increase for a $10,000 withdrawal, 36% tax rate. Why? Because they pushed into the 22% bracket while simultaneously pushing more Social Security into the taxable column. This is the tax torpedo zone. Between roughly $60K and $100K of income, you are paying marginal rates that are double what you expect. You aren't paying 12% or 22%, you are paying 36%, 40%, sometimes nearly 50%. And remember, this is money you deferred to save on taxes. If you deferred at 24% while working, only to pay 40% while retired, you have made a catastrophic financial error. You bought high and sold low with your taxes. The widow's penalty, the ultimate trap. If the tax torpedo is a headache, this next part is a heart attack. We have to talk about the widow's penalty. This is the most overlooked risk in retirement planning. Let's go back to Bob and Linda. They are navigating the tax torpedo together. They are married filing jointly. The standard deduction is high, $31,500 plus. The tax brackets are wide. But one day, Bob dies. Linda is now a qualifying widow for the rest of that year, but starting Jan 1st of the next year, her filing status changes to single. Here is what happens to Linda's finances. Income drops slightly, she loses one of the Social Security checks, the smaller one, but she keeps Bob's larger check and all the investment income, so often her household income only drops by maybe 20 to 30%. Tax brackets cut in half. The single tax brackets are exactly half the size of married brackets. The 12% bracket ends much sooner, the 22% bracket kicks in much faster. Standard deduction cut in half. It drops from $34,000 to $17,000. Let's see the impact. While married, Bob and Linda had $100,000 of income and paid a blended rate of maybe 12%. Now, Linda has $80,000 of income, but because she is single, she is shoved into the 22% or 24% bracket almost immediately. And the tax torpedo thresholds for singles, they're lower too, $25,000 and $34,000. So Linda is paying more tax on less income. It is not uncommon for a surviving spouse to see their tax bill double after their partner dies. This is why deferring everything is dangerous. You are leaving your spouse with a tax bomb that will detonate exactly when they are most vulnerable, when they are alone, grieving, and trying to manage the household finances solo. If you love your spouse, you need to fix your tax allocation now while you are both alive to file jointly. The multiplier effect, IRMAA and NIIT. We aren't done. I told you this was a deep dive. The tax torpedo doesn't travel alone. It has an ugly sister called IRMA. This stands for Income-Related Monthly Adjustment Amount. Basically, Medicare Part B and Part D are not free. You pay a premium. For most people, it's about $185 a month in 2025. But if your income crosses certain cliff thresholds, the government adds a surcharge. The cliffs for 2025 are roughly $106,000 single, $212,000 married. Here's the kicker. IRMA is a cliff, not a ramp. If you make $212,000, you pay the standard premium. If you make $212,001, just $1 more, your premiums jump. For a married couple, stepping over that line by $1 can increase your annual premiums by roughly $1,600. Think about the marginal tax rate on that. You earned $1 extra. You paid 40 cents in income tax, torpedo. You paid $1,600 in Medicare surcharges. That is a marginal tax rate of 160,000%. Okay, that's hyperbolic, but effectively that $1 cost you more than it was worth. If you combine the tax torpedo with an IRMA cliff, there are narrow bands of income where you are simply lighting money on fire. And guess what triggers IRMA? RMDs. When you turn 73 or 75 for younger viewers, the government forces you to take money out of your IRA. If your IRA is big enough, say $1.5 million or $2 million, your RMD alone might be $80,000 or $90,000. Add Social Security, add a pension. Suddenly, you're forced over the IRMA cliff. You are forced into the tax torpedo. You have no choice. The government is driving the car and you're locked in the trunk. The psychology of tax-deferred addiction. So why do we do this? Why do millions of smart people walk blindly into this trap? It comes down to human psychology, specifically hyperbolic discounting and loss aversion. 1. The now bias, hyperbolic discounting. We value a $100 benefit today much more than a $200 benefit in 20 years. When you are 35 years old, 65 feels like a different lifetime. You think, I'll figure it out then. Well, then is now. 2. The illusion of ownership, mental accounting. When you log into Fidelity or Vanguard and see $1 million in your 401k, your brain registers that as my money. It is not your money. You have a partnership with the federal government. You own about 70 to 80% of that account. The government owns the other 20 to 30%. But here's the scary part. The government is the majority shareholder who can change the bylaws at any time. They can change the tax rates. They can change the RMD age. They can change the rules on inherited IRAs, which they just did with the Secure Act. By keeping all your money in the tax-deferred bucket, you are giving the IRS a variable equity stake in your life savings. If tax rates go up to 50% in the future, the IRS owns 50% of your account. If tax rates stay low, they own 20%. Why would you bet your retirement on the whims of Congress? How to disarm the torpedo, the action plan. Okay, take a breath. I know that was a lot of bad news, but here is the good news. This is a solvable math problem. If you are 55, 60, or even 65, you can fix this. You just need to stop operating on autopilot. Here is your 4-step battle plan to defeat the tax torpedo. The Roth conversion ladder, the gap years. This is the nuclear weapon against the tax torpedo. The goal is to move money from the tax-deferred bucket to the tax-free bucket, Roth, before RMVs start. The best time to do this is in your gap years. This is the period after you retire, say age 60, but before you claim Social Security, say age 70, and before RMDs, age 73. During these years, your income is naturally low. You've created an artificial income valley. During these gap years, you don't just sit there. You voluntarily create taxable income. You convert, say, $50,000 or $100,000 of your IRA into a Roth IRA. Yes, you pay taxes on it now. You write a check to the IRS. but you pay that tax at the 10%, 12%, or 22% rate. You are filling up the low brackets. By paying 12% now, you reduce the size of your IRA. Smaller IRA equals smaller future RMDs. Smaller RMDs equals you stay out of the tax torpedo zone later. And that money grows tax-free in the Roth forever. You are paying a known tax today to avoid an unknown and likely higher tax tomorrow. Asset location, the three-bucket strategy. You need flexibility. If all your money is in one bucket, you're handcuffed. You want to build three distinct buckets. Taxable brokerage, stocks, ETFs, you pay capital gains tax here, 0%, 15%. This is your bridge money for early retirement. Tax deferred, traditional IRA, 401k, keep enough here to fill up your standard deduction every year, but not so much that it explodes. Tax-free, Roth IRA, HSA. This is your surge capacity. Let's go back to the boat example. If Bob needs $40,000 for a boat and he has a Roth IRA, he pulls the $40,000 from the Roth. Taxable income generated, $0. Provisional income increase, $0. Tax torpedo, disarmed. The Roth allows you to make large purchases without triggering the provisional income formula. It is your financial stealth bomber. QCDs, the qualified charitable distribution. The RMD escape hatch. If you are already over 70.5 and you miss the boat on Roth conversions, you have one secret weapon left, the qualified charitable distribution. If you give money to charity, church, animal shelter, food bank, stop writing checks from your bank account. Instead, tell your IRA custodian to send the check directly to the charity. Why? Because a QCD counts towards your RMD, but it is excluded from your taxable income. It lowers your magi. It lowers your provisional income. It can literally save your Social Security from being taxed. Example, your RMD is $30,000. You normally give $5,000 to your church. If you do it as a QCD, the IRS only sees $25,000 of income. That $5,000 reduction might be just enough to keep you under the tax torpedo threshold. Strategic Social Security deferral. If you have a large IRA, consider living off the IRA first from age 62 to 70 and delaying Social Security until age 70. It feels scary, like I'm spending my savings, but mathematically it works. You are burning down the IRA balance, reducing future tax bombs. You are letting Social Security grow by 8% a year, guaranteed, inflation adjusted. By age 70, you have a smaller IRA and a massive tax advantage Social Security check. You have smoothed out the income spike. What about Q&A section? Now, I can hear the comments section typing away. Let's address the most common objections I get when I talk about this. Objection 1. But Bond, I don't want to pay taxes now. I hate writing checks to the IRS. I get it. It's painful. Loss aversion is real. But you have to ask yourself, would you rather pay $10,000 in taxes today or $30,000 in taxes later? Wealth isn't about what you make, it's about what you keep. If you are tax allergic today, you might just be setting yourself up for a financial infection tomorrow. You are tripping over dollars to pick up pennies. Objection 2. What if tax rates go down in the future? Look at the national debt. We are at $35 trillion and counting. Medicare and Social Security are facing insolvency. Do you genuinely believe that income tax rates in the United States are going to be lower in 15 years? Historically, we're near all-time lows. In the 1970s, the top rate was 70%. In the 1950s, it was 90%. Right now, the top rate is 37%. The 2017 tax cuts are set to expire in 2026. Betting on tax rates dropping is a very, very risky gamble. I'd rather lock in the known rates of today than gamble on the mercy of a future Congress. Objection 3. My CPA didn't tell me this. I love CPAs. They're great at compliance. Compliance means, here is what happened last year. Let's put it on the form correctly. That's looking in the rearview mirror. You need tax planning. Planning means, here is what we're going to do for the next 10 years to minimize the lifetime bill. Most CPAs are too busy during tax season to do forward-looking planning. You have to ask for it, or you need a financial planner who specializes in retirement tax efficiency. We've covered a lot: the tax torpedo, the widow's penalty, IRMA, provisional income. If your head is spinning, that's okay. It's complicated on purpose. But here is your homework. 1. Calculate your provisional income. Pull out your last tax return. Look at line 6A, Social Security, and your AGI. Run the formula: AGI plus tax-free interest plus 50% of Social Security. Are you near the 32,000 or 44,000 thresholds? 2. Check your tax diversification. Do you have 99% of your money in pre-tax IRAs? If so, you are a sitting duck. Start looking at Roth conversions. 3. Run a mock return. Before you take out that extra $20,000 for the boat, use a tax software or ask your advisor to run a what-if scenario. See exactly what it does to your marginal rate. You have worked too hard to let a quirk in the tax code eat your golden years. The system is complex, yes. It feels unfair, yes. But now you know the rules. And when you know the rules, you can win the game. If you want to dive deeper into exactly how to execute a Roth conversion, the paperwork, the timing, the 5-year rules, I did a whole masterclass breakdown on that right here. And if this video saved you from the torpedo, destroy that like button so the YouTube algorithm can save someone else. My name is Bond. Thanks for watching, and keep building.